Disclaimer.
Have you ever had that nagging feeling that the headlines we see on the news are just a thin veil covering a much deeper, more urgent reality? Well, today is January 14th, 2026, and if you've been watching the silver market, you know that the veil didn't just tear, it completely disintegrated. For months, we've been told that our economy was on a steady path to a soft landing, but the numbers on our screens today are telling a story that the mainstream media is still too terrified to broadcast. Today, the spot price of silver officially shattered the $90 barrier for the first time in history, a move so violent it has sent shockwaves through every major bullion bank from New York to Zurich. But before you think about rushing out to grab whatever silver you can find, I need you to stop and listen closely to what is happening behind the closed doors of our own government. This isn't just another price rally, this is the sound of a system hitting its limit. Something unprecedented is unfolding in Washington that changes the math for every single one of us holding US dollars. We are witnessing a historic confrontation between the Department of Justice and the Federal Reserve, with reports now confirming that Jerome Powell has been served with grand jury subpoenas stemming from a criminal investigation into his congressional testimony. For the first time in our history, the man holding the keys to our currency is facing the threat of a criminal indictment, and the immediate fallout has effectively paralyzed the independence of the Fed. This isn't just political theater, it's a systemic fracture in the very foundation of our financial world. When the gatekeeper of the world's reserve currency is under fire, the Fed put, that safety net we've all relied on for decades to bail out the markets, is officially dead. We are no longer just looking at a price spike in a precious metal. We are looking at a desperate, panicky scramble by the world's largest financial institutions to cover paper bets that they can no longer back up with real physical silver. Think about what this means for our daily lives, our families, and our retirement accounts. We've always been taught that paper represents value. But what happens when the paper shorts are trapped and the banks realize they've sold the same ounce of silver to 100 different people? This is the immediate threat we face today. The surge past $90 wasn't just a market move. It was a loud, clear signal that the paper manipulation machine is breaking under the weight of a reality it can no longer suppress. We have entered a stage where this isn't about investing anymore. It was about the survival of our purchasing power in a world where the rules are being rewritten in real time. Have you noticed how quiet the big banks have been about their own silver reserves lately? It anxious because they know the STOP silver divorce, the total separation of the paper price and the physical reality, has reached its breaking point. Let's look at the facts. According to recent Federal Reserve data and multiple reports from Reuters and Bloomberg, the Justice Department's escalation against Powell is related to his testimony regarding the Fed's massive building renovations, a project that has ballooned to over $2.5 billion. While that might sound like a localized scandal, the implications are global. Powell himself has characterized these charges as pretexts, aimed at intimidating the Fed into lowering interest rates to suit political preferences rather than economic reality. This is a direct assault on the independence of the institution that manages our money supply. When the Fed loses its ability to set policy based on evidence, the dollar stops being a stable store of value and starts being a political weapon. And history shows us that when currencies become political, people move to gold and silver at a speed that leaves the slow-footed behind. The timing couldn't be worse for the banking establishment. As the Powell crisis deepens, the silver market is facing a perfect storm of supply shortages. While the spot price hit $90 today, industrial demand from clean energy and AI sectors is at an all-time high, while global mine production has been in a deficit for 5 consecutive years. We are seeing a world where the physical metal is being sucked out of Western vaults in London and New York and moved east to places like Shanghai and the BRICS nations at a rate we've never seen before. In fact, China just implemented new export restrictions on silver this month, essentially locking their supply inside their borders. This has created a massive regional distortion where the real price to actually hold a silver bar in your hand is skyrocketing far beyond what the tickers are telling us. If you're sitting there thinking this is just a temporary spike, I want you to consider the kill switch that the CME Group, which runs the COMEX exchange, just pulled. They've hiked margin requirements by nearly 50% in a single week. Why would they do that? In the world of high finance, that's bank speak for we are losing control. They are trying to force people to sell their positions because they simply do not have the physical metal to deliver to everyone who wants it. They are trying to protect the bullion banks like JP Morgan and UBS that have spent years betting that silver would stay cheap. But those bets are now blowing up in their faces, and they are looking to us, the American people, to be the ones left holding the bag. Let me put this in perspective for you. If the Fed loses its independence today, the dollar becomes a political tool rather than an economic one. And when that happens, hard assets like silver don't just go up, they reset. We've seen silver gain nearly 200% over the past year, outperforming almost every other asset class we own. But this move to $90 is different. It's the sound of the alarm bell finally going off. It is the realization that the Powell crisis is not just about one man or one building. It's about the end of an era of managed stability. We are entering a period of 1970s-style inflation on steroids, driven by massive fiscal deficits and a crumbling trust in our institutions. So, when I say stop, I mean stop listening to the reassurances of the people who didn't see this coming. Stop believing that the spot price is the only number that matters. While the screen says 90, the reality at your local coin shop is that premiums are hitting $20 an ounce or more. That means our fellow Americans are paying $110 to actually secure their wealth in a form that no government can print away and no bank can freeze. We are seeing a total disconnect between the paper game and the physical truth. And in that gap, fortunes are being lost by those who trust the paper, while those who understand the physical reality are preparing for the greatest transfer of wealth in our lifetime. Have you looked at your own portfolio lately? Have you thought about what happens to your savings if the COMEX officially defaults because they can't find the metal to settle their contracts? This isn't a what-if scenario anymore. It's the conversation happening right now in the boardrooms of the world's largest investment firms. They are terrified of what happens next, and they should be. But for us, this is a moment of clarity. It is a moment to realize that the silver betrayal is not just coming, it is already here. The system is showing us exactly what it is, a house of cards that requires a silent Fed and a cheap silver price to survive. Today, both of those pillars have crumbled. As we move forward, we have to look at the evidence the banks are desperate to hide. We have to look at the documents and the insider actions that prove the scramble for physical metal is much more desperate than they are letting on. Because while $90 is a milestone, it's just the beginning of the repricing of our entire world. We aren't just watching a market, we are watching history. And in history, the people who thrive are the ones who saw the patterns before the rest of the world caught on. It is time we look at the proof that this is not just a rally, it's a default in slow motion. And the Powell crisis is the spark that just lit the fuse. Now, let me pull back the curtain on why this $90 mark isn't at just a random spike. It is the moment the paper game hit a wall of cold, hard physical reality. We'd have all seen the charts where farmers of paper silver is traded in volumes that would require 10 times the world's actual silver supply just to settle. But today, that leverage is backfiring in a way we haven't seen in our lifetime. Here is the first piece of evidence that should make every American investor take a step back. The CME group, which manages the COMEX, just fundamentally altered the rules of engagement. Starting yesterday, January 13th, 2026, they officially abandoned fixed dollar margins and switched to a percentage-based system. On the surface, it sounds like technical jargon, but in our world, that's a kill switch. By setting initial silver margins at a staggering 9% of the total contract value while the price is vertical, they are effectively pricing out the small player and forcing a massive involuntary deleveraging. Why would an exchange do this? Because the banks are trapped in a short squeeze of historic proportions, and the exchange is doing everything in its power to prevent a total systemic default that would leave the bullion banks bankrupt. But here's where it gets even more revealing for us. If you look at the internal COMEX data from this morning, something extraordinary is happening. Traders are rolling backward. Normally, in a healthy market, people move their contracts further into the future to keep their positions open. But right now, we are seeing thousands of contracts being moved from March back into January for immediate delivery. This is the financial equivalent of a bank run on physical metal. People no longer trust the promise of future delivery. They want their silver in their hands, and they want it now. This desperation is fueled by what we are calling the Great Divorce of 2026, a total separation between the paper price and the physical truth. While we watch the spot price struggle to reflect reality here in the West, the Shanghai Gold Exchange has been trading at a massive premium, with prices already clearing the $100 mark when converted. This isn't just a price gap, it's a giant vacuum. The East is literally sucking the physical metal out of London and New York vaults because they value the metal more than the paper dollars we're using to trade it. Think about the institutions we've been told are too big to fail. Right now, across the Atlantic, UBS, the giant that swallowed Credit Suisse, is in an open public brawl with the Swiss government. They have been hit with a demand for an additional $24 billion in emergency capital to meet new Basel forwarders' safety standards. UBS's leadership has essentially told the regulators no, arguing that such a demand would destroy their international competitive edge. When a global bullion bank, one of the primary architects of the silver market, admits it has a $23 to $24 billion hole in its balance sheet, we have to ask ourselves, how much of that paper silver they sold us actually exists? They are fighting for liquidity while the silver they supposedly hold for us is being called for delivery by investors who have lost all faith in the system or its integrity. This isn't just a theory anymore. We are seeing it in our own neighborhoods, right here at home. Have you tried to find an American silver eagle at a reasonable price this week? According to the latest dealer data, while the spot price officially sits at roughly $90 today, the street price, what we actually have to pay to get a coin in our hand, has hit a staggering $110. That is a $20 per ounce premium, a level of market distortion that indicates a total breakdown in the supply chain. It tells us that the official price is a hollow lie. The market is telling us that the metal is gone, and the paper price is just a ghost lingering in the machine. What should grab our attention is that even the US Mint is struggling to keep up. They've already announced the upcoming releases for 2026 at significantly higher base prices, but secondary market pre-sales are already clearing $100. We are witnessing the regional redistribution of wealth in real time. Last year, we saw a massive movement of silver into US vaults as people feared new trade policies. But now that metal is being called home by global industrial giants and sovereign states, they realize that in a world of political uncertainty and legal threats against the Fed, only physical assets carry no counterparty risk. According to recent reports, the London float, the amount of silver actually available for sale in the London vaults, has reached critically low levels, hitting its lowest point in the 21st century. This brings us back to the Powell crisis. When the DOJ serves subpoenas to the Fed chair over building renovations, it's rarely just about the architecture. It's about leverage. If the independence of the Fed is undermined, the full faith and credit of the United States becomes a variable, not a constant. Global investors are watching this and concluding that the US dollar's management is becoming politically constrained. This is why we saw silver blast above $86 on Monday and hit $90 today. It's a flight to reality. The banks like JP Morgan and HSBC might tell us that silver is overvalued, but their own actions tell a different story. They are hiking margins and fighting capital rules because they are terrified of the physical delivery demands they cannot meet. We have to ask ourselves, why is the Shanghai premium so persistent? Why is China willing to pay 10% more for silver than we are? It's because they understand the industrial math. Silver demand for AI chips and solar panels is projected to hit record highs this year, yet silver mine production remains stagnant. We are in the 5th year of a structural deficit. You can print $1 trillion to pay for a building renovation or a stimulus package, but you cannot print an ounce of silver. And when the world realizes that the paper representing that silver is just an entry on a bank's ledger, a bank that is currently fighting its own government for survival, the rush for the exits becomes a stampede. We are in that stampede right now, and the $90 price tag is just the first hurdle. Think about this scenario. If you had a contract for silver and the exchange told you they could only pay you out in cash because they didn't have the metal, would you be happy with $90 when the guy next door is selling his physical coins for $110? Of course not. That's a default. And that is exactly what the percentage-based margin system is designed to manage. It is an insurance policy for the exchange, not for you. They are protecting the system, not our savings. Our country's financial stability has always relied on the transparency of these markets, but today, that transparency is gone. We are left with a choice. Do we trust the paper tickers managed by a Fed under investigation, or do we trust the physical metal that is currently being hoarded by every major power on the planet? The evidence is clear. The deep dive reveals a system that is out of time, out of metal, and out of excuses. We've looked at the political paralysis in Washington and the desperate rule changes at the exchanges, but now we have to face the most uncomfortable truth of all. The cold, hard, and undeniable math of a global financial system that has finally run out of room to maneuver. Today, January 14th, 2026, SEC isn't just another Wednesday on the calendar. It is the day the global financial map officially split in two. While we have been distracted by the internal power struggles at the Fed and the headlines about building renovations, the BRICS nations have just pulled the trigger on a project that effectively ends the era of total dollar hegemony. The official pilot launch of the unit, a digital trade currency backed to 40% by physical gold and 60% by a basket of BRICS currencies, has created a mathematical black hole that is beginning to swallow the value of our fiat dollars in real time. Think about the sheer scale of this shift for a moment. This isn't just about another country launching a central bank digital currency. It's about a new neutral settlement system where value is anchored to something the government cannot print and the Fed cannot manipulate. For over 80 years, the US dollar has been the primary way nations settled their debts. But the unit allows nearly half the world's population to trade without ever touching a US bank or using the SWIFT system. If just 10% of the massive reserves held by these emerging economies move away from US treasuries and into this gold-anchored system, we are looking at a liquidity shock to our markets that would dwarf anything we saw in 2008 or 2020. This is why silver didn't just rally to $90 today. It escaped the orbit of the old system. The math of the silver market is even more unforgiving than the geopolitics. We are currently in the 5th consecutive year of a structural supply deficit. For 5 years, the world has consumed more silver than it has pulled out of the ground. And for 5 years, that gap has been filled by drawing down inventories in London and New York. But today, those vaults are hitting critically low levels, or what analysts call thin air. When you combine this physical shortage with the fact that China officially implemented new silver export restrictions on January 1st, 2026, you realize that the West is no longer just facing a price increase. We are facing a total supply shutoff. China isn't just keeping silver for profit, they are keeping it for survival, as it is the critical component for the AI chips, solar panels, and defense systems that will define the next decade. Now, let's talk about the gold to silver ratio per day, which is the ultimate truth teller in history. As we enter 2026, this ratio is already compressed from over 80 to 1 down to roughly 154 to 1 now. But why does this matter to us? Historically, the ratio is set closer to 15 to 1 or 20 to 1 when silver was used as money. But let's go deeper into the paper versus physical trap that has been set for us. Did you know that in the paper silver markets, there are often hundreds of ounces of paper silver traded for every single ounce of physical metal sitting in a vault? For decades, this leverage worked because people were content to settle in dollars. But today, with the Powell crisis and the threat of Fed subpoenas, trust in those dollars is evaporating. If only a small fraction of paper silver holders suddenly decide they want their actual metal, the COMEX officially defaults. There is simply not enough silver on planet Earth to satisfy the paper claims. This is why the exchanges are hiking margins. They're trying to force us to sell our paper before we realize the vault is empty. What should grab our attention is the industrial black hole. Solar consumption of silver hit a new all-time high last year and is projected to exceed 200 million ounces in 2026. Add in the massive electricity loads of AI data centers, and silver becomes one of the few metals whose demand curve steepens every single year. There is no substitute. Every attempt to replace silver in these high-efficiency semiconductors has resulted in inferior performance. So, we are entering a year with demand that keeps rising and a supply that physically cannot keep up. It is the definition of a structural bottleneck that favors the holder of the physical asset. Let me give you a final warning as an American, sharing this intelligence with my fellow citizens. We are watching the great silver betrayal reach its climax. The people who tell you to wait for a dip or to trust the paper tickers are the same ones who will be cash settled when the system finally snaps. They will give you your $90 in paper, but by the time that cash hits your account, it won't be able to buy you the silver that just jumped to $150 on the street. We've already seen physical premiums hit $20 an ounce today. That is the market screaming at us that the paper price is a fraud. Have you noticed how the smart money is behaving? Central banks aren't buying paper contracts. They are accumulating physical bars at record speeds, shifting their reserves away from US dollar holdings. They are preparing for a world where the Fed is paralyzed and the US dollar is no longer the only game in town. If Jerome Powell is actually indicted or removed, the last shred of market belief in a managed currency will vanish. At that point, the rush for silver won't be about profit. It will be about the preservation of everything you've got to work for. Think about your own situation. If the COMEX settles in cash and your local dealer has empty shelves, what is your paper wealth worth? We have a choice to make today. We can choose to stay in the burning building of unbacked paper contracts and political pretexts, or we can choose to recognize the patterns that history has shown us time and time again. The $90 mark was the alarm. The move to $110 in the physical shops was the final warning shot. The math tells us that the door to secure physical metal at these prices is closing, and it's closing with a bang. We've always been a nation that values self-reliance and hard truth over easy lies. It's time we get pragmatic about our own financial survival. Don't wait for the mainstream media to give you permission to protect your family. By the time they admit what is happening, the vaults will be empty and the price will be out of reach for regular people. We are witnessing the greatest wealth transfer in history, and it is happening right under our noses. Stay alert, keep your wealth in assets you can actually hold, and remember, in a world where the system is breaking, the only real truth is what you can hold in your hand. Our country has survived crises before, but only because people like us saw the truth and acted while there was still time. The clock is at midnight. The question is, are you ready?